even though we're at that stage, gold is still going up to new all-time record highs. I mean, it shouldn't be that way. The gold should really only be at all-time record highs immediately after an inflationary spurt. We're at all-time highs in this situation right now. I thought we would be lower, and the fact that we're at all-time highs means we have a long way to go when the next inflation round starts. Placing a bet on the price of gold, and a bank like JP Morgan is saying, "Well, I think gold's going to go down the next month." I predicted this, that we're going to be around 240 billion. I think I even used that number.
Gold prices are hitting new all-time highs, which is unusual because they typically reach such levels following an inflationary spike. It expected gold to be lower, and the current highs suggest a longer journey ahead as inflation rounds resume. Banks like JP Morgan aren't supposed to gamble on gold prices, yet predictions are being made that gold could reach around $2,400. Rafi Farber, a financial analyst known for his insights on precious metals and macroeconomic trends, particularly focusing on gold, silver, and central bank policies, explained banks are engaging in gold swaps, where they go short in New York and long in London, theoretically without much risk. However, the situation becomes unclear because it's not fully known who owns the gold in London, and even the banks may be unsure. Despite this, swaps are at record short levels, with around 250,000 short contracts. Someone has to sell these short contracts to allow others to go long, providing liquidity in the market. The speaker Rafi Farber points out that around 25 million ounces of gold are tied to short contracts, but it's uncertain if that amount even exists in London. When open interest in gold contracts rises alongside the price, it's normal, but at all-time highs, it suggests bullion banks are opening new short contracts. A true short squeeze, at least in New York, would be signaled by falling open interest with rising gold prices, which hasn't happened yet. The speaker warns that while this situation might not lead to a financial system collapse, it could indicate trouble ahead, especially in the broader economy. Rafi Farber suggests that when reverse repos run out, banks will have to rely on their reserves, but around 70% of those reserves are already tied up in repos. Once this happens, overnight interest rates between banks could spike dramatically, potentially reaching 10%, as they did 5 years ago. The speaker notes that reverse repo levels have already dropped to around $45 billion, indicating a looming issue. Let's dive into the video for more insights. If you enjoy the content, don't forget to give us a thumbs up and subscribe to our channel for the latest updates.
That's not what they're doing. They're called swaps, meaning they swap gold from New York to London. They go short in New York and they go long in London. And then if a client, stands for delivery, they just deliver the gold or they do an exchange for physical from the position in New York to the position in London, and they're not really technically risking anything. However, so when we talk about short squeeze, why is it even worth talking about then? Because maybe they're not. We don't really know what they're doing and who really owns the gold in London. And you can come up with all these theories on who owns what, but the fact is nobody really knows. Probably not even the bank knows. So what I'm basically talking about is that the amount of contracts net that these swaps, the ones that are supposed to be short in New York and long in London, supposed to be, they're record short. They have the record amount of contracts that they're selling short. Now, obviously, somebody has to sell short in order for somebody else to go long, right? You can't go long off of nothing. So somebody's got to sell the contract. So they sell the contract and they provide the liquidity in the market. That's what they're supposed to do. They're short like something like 250,000 contracts, maybe a little more. And that's what, like 2.25 million. What's 250 times 100? 250,000 times 100. That's 25 million ounces. Does that even exist in London? I don't think it does. So something's off here. And the fact that open interest went up last week, and it went up about 40,000 contracts, and the price of gold went up with it. That's normal. The price is supposed to go up with open interest. But at all-time highs, it means that the bullion banks are opening these new short contracts at the all-time highs. Now, if we're going to see a short squeeze, at least on the New York side, what we should see is falling open interest with a rising gold price. We almost never see that. Which tells you that at least theoretically they are balanced. They're short New York, long London, because they're not pressured. So they wait for the price to fall, and then for people to either book their profits or whatever they're doing, and then they exchange the contracts. But if we did see one time falling open interest and a rising price, and that was into the 2011 top in September 2011. For about 2 or 3 months, we saw it falling open interest, rising gold price. We're not seeing that yet. If we start seeing that, then we can say it's a short squeeze. I don't know if that means they're going to default in London. I'm not making like apocalyptic predictions here to say that the monetary system is going to die on a short squeeze. I don't, but this could be a sign that we're going in that direction. So watch open interest. If the open interest goes down and price goes up, then we're on a New York size short squeeze. And what that does to the bullion banks, frankly, I don't really know. If there's no more reverse repos, it's going to come from the bank reserves, and there's not enough money there. 70% of it's being used for repos already. And once you get too high, then there's going to be a repocalypse, meaning the interest rates, the overnight interest rates between banks are going to rise to like 10%, just like they did 5 years ago tomorrow. So this is going to happen when the reverse repos run out.
Rafi Farber explains that if you hold dollars, you are effectively short silver and gold, as dollars historically derive from stored precious metals. In the silver futures market, open interest has dropped by about 60,000 contracts since May, while the price has remained around $30. This drop in open interest creates potential for speculators to establish long positions, fueling a future rally. Once silver breaks above $30, the price could rise quickly to $50, potentially within months, as there's significant room for upward movement in the market. When the Federal Reserve shrinks its balance sheet, it stops reinvesting in treasuries, effectively removing dollars from the economy. The government repays the Fed using taxpayer money, which is then vacuumed out of existence. However, at the same time, the government issues short-term treasury bills, T-bills, funded by reverse repo earning interest at the Fed. This creates a circular process where money is drained from the banking system, but then replenished through reverse repos. The key question is what happens when reverse repos are exhausted and where additional dollars will come from. Let's get back to the interview.
Silver short squeeze, if you're referring to futures, first of all, let's just like reframe what a short squeeze is in terms of gold and silver, right? If you're long the dollar, if you have dollars in your bank account, I know this might seem like an academic or philosophical point. I guess it is, but it's something I had to keep in mind. If you own dollars, then you are short silver and gold. Okay, that's just to get a floor here on what we're talking about. Because if you own what are dollars originally? Dollars are a substitute or a derivative of originally the silver and the gold that people stored in the banks in order to get the dollars to spend them. Right. So once you own a dollar, you are by definition short silver. You've already sold it to a bank, and now it's sitting somewhere in a coin shop. How the silver got there is through some chain. And now it's there, and now you have the dollar. It's been generations later. Essentially, that's the final short squeeze in silver is going to be the silver parabola up to the 15-to-1 ratio, whatever the dollar amount that's going to be. I don't know. So I have noticed that the open interest in silver futures, if we're going to narrow down the discussion from philosophy to actually practical, what's going on in the futures market now, the open interest, if I remember correctly, has gone down since May from 190,000 contracts, which is pretty high for silver, to I think now it's like 130, but say about 60,000 contracts down. That's about a third of closed, and the price is the same. It was close to $30, maybe it was like 27, 28 in May, something like that, and now it's 30. I mean, I hope I'm right about that. I don't track it every day or know which month what price it was exactly. But we're essentially at 30 again, and open interest is reset lower, which means that there's a lot of fuel in the futures market for speculators to establish long positions at these prices and bring open interest up again. So I don't know when when the rally is going to start from 30 to say 50, or when that really shot is going to be. I think it's going to be quick. Maybe there's going to be like a stop at 40, but like once we pass 30 and we're comfortably above it, I think the trip to 50 is going to take, a matter of months or less. When the Federal Reserve shrinks its balance sheet, it gathers dollars in from whatever parts of the economy to buy, and then the debt that's on its balance sheet, whatever treasuries it is, gets repaid to the Fed. The Fed doesn't reinvest the dollars. The dollars come from wherever, from whoever owns the other side of the treasuries. Essentially the government, right? They're paying it back, but the government gets the money from taxpayers, right? It's vacuumed up through the federal government to the Fed. The Fed takes it out of existence, and then what happens is the government issues a T-bill, right? A short-term treasury bill for dollars that comes from the reverse repos that are earning 5.3% back at the Fed. So there's like this store of money at the Fed while the Fed is sucking dollars out of existence from the Treasury to the Fed out of existence. They're putting money from the reverse repos back to the Treasury, right? When the Treasury sells a T-bill, and that money in the Treasury goes and spreads out throughout the world on whatever the government decides to spend money on. So really, it's like money's being vacuumed out of the banking system and then being shoved back into the banking system through the same treasury mechanism to the reverse repos. So then the question, we have this circle going on, this like drain going on, but it keeps being refilled by the reverse repos in the same direction. So the question is like, what happens when there's no more reverse repos? Where are the other dollars going to come from?
The current dynamics in gold and silver markets, combined with the Federal Reserve's monetary policies, highlight growing uncertainty and potential challenges ahead. As reverse repos deplete and market forces shift, both precious metals and economic liquidity are set to face significant changes. What are the long-term implications of a depleted reverse repo market on bank liquidity and interest rates? How might a potential short squeeze in gold or silver affect broader market stability? Share your thoughts in the comments below. We'd love to hear from you. If you found this video useful, don't forget to give it a thumbs up and subscribe for more content. Thanks for being a part of our journey.